Introduction to Asset-Liability Management in Banks. Asset-Liability Management, ALM, is a crucial practice within banks, designed to manage and mitigate risks that arise from discrepancies between the assets and liabilities. In essence, it's about balancing what the bank owns versus what it owes to ensure financial stability and compliance with regulatory requirements. The importance of ALM. ALM is not just about balancing books. It's a strategic maneuver that helps banks to optimize their profits while managing risks, such as liquidity, interest rate, and currency risks. Components of ALM. Interest rate risk. One of the critical components that ALM addresses is interest rate risk. This is the risk to the bank's earnings and capital arising from movements in interest rates. Managing this risk involves understanding the gap between assets and liabilities and the repricing or maturity mismatches that might exist. Liquidity risk. Liquidity risk involves the bank's ability to meet its obligations as they come due without incurring unacceptable losses. ALM focuses on ensuring that a bank can always meet its short-term and long-term obligations through proper cash flow management and maintaining an adequate liquidity buffer. Market risk. Market risk is the risk of losses in on- and off-balance sheet positions arising from movements in market prices. While primarily concerned with interest rate and liquidity risk, ALM also touches on managing risks associated with market movements, such as changes in the foreign exchange rates. The ALM process. Setting up an ALM committee. The first step in establishing effective asset liability management is setting up an ALM committee. This committee, usually comprising senior management from various departments, is tasked with making strategic decisions based on the ALM reports and risk assessments. ALM information systems. Banks rely on sophisticated information systems to collect, process, and analyze huge volumes of data for ALM purposes. These systems help in forecasting cash flows and evaluating the bank's financial health under various scenarios. Risk analysis and management. Central to ALM is the continuous process of risk analysis and management. This involves identifying risk exposures, measuring the impact of those risks, and implementing strategies to manage or mitigate them. Techniques like gap analysis, duration analysis, and value at risk (VAR) are commonly used for this purpose. Compliance and regulatory requirements. Regulatory bodies have set specific requirements for banks concerning ALM, including stress testing and liquidity coverage ratios. Banks must ensure that their ALM strategies are not only effective for risk management, but also compliant with these regulatory requirements. Strategies for effective asset liability management. Diversifying the asset portfolio. One key strategy is diversification of the bank's asset portfolio to spread and mitigate risk. This might include a mix of short-term and long-term investments, fixed and floating rate loans, and diversification across industries and geographies. Matching and hedging. To manage interest rate and liquidity risks, banks often strive for a close match between the maturity profiles of assets and liabilities. Additionally, derivative instruments like futures, swaps, and options can be used to hedge against specific risks. Dynamic financial modeling. Banks use dynamic financial modeling to simulate various economic conditions and interest rate scenarios. These models enable banks to forecast their financial position and adjust their asset and liability strategies proactively. Conclusion. Asset liability management is intricate, but fundamentally essential for banks. By effectively balancing the assets and liabilities, banks can not only secure their financial health against a range of risks, but also position themselves for sustainable growth. Want to learn more? Claire Trifle on LinkedIn.